Good morning, and investors. It is Friday, May 16th. Thank you, everyone, for the amazing birthday wishes yesterday. I had an awesome, epic day, really relaxing and spending time with the family. Anyways, let's jump into the charts. We've seen here, let's just jump over to the S&P 500 futures. The markets are up about, depending on the indice, we're up about 0.3% to 0.7%. If we take a look at the S&P 500 and we look at the daily chart, you can see here we've got this Fibonacci level that we've been looking at. We've popped up. We've been trading sideways for the last couple of sessions. We tagged, let me just zoom in a bit more. We tagged this blue line here, the 5-day moving average, which is a high momentum move. Typically, if you're in a high momentum environment, it will naturally want to stay above that level. We see we're rallying up. We kind of pause for a couple of days. The 5-day catches up. It pauses. It kind of catches up. It pauses and the market rallies. We tagged it yesterday. The market is set to open higher again today. We'll see how this market continues to unfold. We have been seeing money flip and flop. Yesterday, more or less, the NASDAQ was relatively flat while small caps and things moved higher. Today, we actually have the NASDAQ up about 1/3% and the small caps up about 0.6%. So twice as much. More or less telling us that this is a little bit more of a broad market rally. The market is trying to strengthen. The Russell 2000, a nice chart pattern. It is set to open higher and could continue to pop and rally. So money is kind of flowing out of, we're seeing money flow out of gold, which was the crowded play. Everybody loved gold, and now it has been moving down. And you can see here in pre-market early this morning, some heavy volume to the downside. And the momentum shifted a couple of sessions ago. We can see on our 30-minute chart, it goes from an oversold kind of buy signal to a target, and then back down to a buy signal, and then it got its momentum stalled out, went orange, and more or less now it is set to open down around 178, back down at these lows, and could pick up speed and continue to unwind even more. So money's coming out of what was the hottest commodity or the asset, which was gold, and it's going into stocks, and more so broad market stocks, small caps in general versus just the large. We're going to see silver trading lower this morning. Gold miners are trading lower this morning. And if we take a look over at the energy space, we've got oil up about 0.5%. Now, oil's kind of all over the place. It kind of came up, got rejected at the 50-day, and also right up into this high from about a month ago. We saw some selling. So we'll see how that kind of unfolds over the next little bit here. No real insight in oil other than I believe the trend is to the downside, and it is really just going to hold its ground here before, I think, having another move lower. I guess we'll have to see how this market reacts when we look at the S&P 500. Let's just go back to the S&P 500 and look at the longer term view. We'll just have to see if this is a full-on V-shaped recovery like after COVID, and then it stumbles and gets traction and wants to start something new, or if this is a giant dead cat bounce and it eventually stalls out at some point and rolls over. I shared this yesterday. I think it was the 2001 financial crisis. We've seen 22, 28% rallies. We've seen a 64% rally, a dead cat bounce in the NASDAQ before it even rolled over. So dead cat bounces, if you're below the highs, if you're still in a bearish environment, dead cat bounce can be very significant. I guess I could just pull this up real quick and go to QQQ. If we go and we take a look, we'll just go to the weekly chart, and I'll zoom way back here. You can see how this plays out. More or less, we go from a stage 1 or stage 2, it fully blows off, has the big crack to the downside, and then goes into this consolidation phase, and then went into a multi-year bear market, sold off like 94%. If you look at the drop that we had initially, 47% drop just to put in the topping phase for the NASDAQ. And then it ended up rallying 64% in this bear market rally before it went off a cliff. And the entire sell-off here down at the lows was about an 82 or something percent pullback. So very significant pullback. And the NASDAQ took 16 years to recover. Just keep in mind, dead cat bounces and bear market rallies and pauses can last a long time, many months. They can be massive percentage moves, and it doesn't matter how big the first crack to the downside is. It could be 10%, could be 8%, could be 47%. It doesn't matter how far it goes. It's how the market reacts afterwards, and then if it starts to roll over and head down, or if the market strengthens and generates new buy signals. So we just have to see. Obviously, we've had tariff kind of pullback, sharp news-driven pullback. The economy, I believe, is weakening, but we also have positive tariff news that things are going to get sorted out, that all this is just smoke and mirrors, and people are buying into, I think things will get resolved and the market's coming back to where it was. So a ton of volatility, ton of uncertainty, which is why we need to manage our positions and risk going forward here. If we take a look overall at the hot list, we've had stocks and sectors moving all over the place. What is now at the top of the list, the ARKW ETF, was about a month and a half ago at the bottom. It was the worst asset. Now it's the best. And this just goes to show how volatile this market is. We've seen a 37% drop, and then we've seen this 52% pop and rally as it carves out this bottom. So things are all over the place. Our Bitcoin, with our band strategy, we've long Bitcoin. It's flagging sideways here, primed and ready for potentially another big pop and run. We've already locked in gains on this, so we're just letting it mature. It's either we make a bunch more money, or we just have locked in a small profit and we move on if it does roll over. Again, Bitcoin was at the top of the list. Same with uranium. We're long uranium. We've locked in gains with that strategy. It continues to push higher, and could hopefully have another extension to the upside. It's getting closer to our 15% target on that play. And again, we'll be closing out some position if we get there. But overall, gold GLD was at the top of the list. It was a trade that we did. We ended up getting into GLD right here. We sold half of our position here. We sold the rest at break even in case the market rolled over, and it has broken down. It's bouncing back up. It is set to open lower again today, and we don't really want to hold something. Either it was going to have high momentum and take off, or it was going to be a struggle, and we don't want anything to do with it if it's not showing strong signs of upside move right away. We want to protect our capital, lock in gains. This is a stage 3 choppy market still, and it's just how it is. Manage your positions and risk. It's about a bunch of first or second base hits only. Just get in, lock in the gains, protect your position, move on, find something fresh that's ready to pop. We haven't looked at the Magnificent 7 basket for a while, so here's the MAGS ETF. You can see it's put in this high volatility bottom. It's pretty much carved out. It's popped. It's broken to the upside. It's going to have some pretty serious resistance somewhere up into this range, up into here. So it does have more room to continue to push and squeeze higher. We'll see how this unfolds, but it's trying to get some momentum and hold its ground. Obviously, if the Magnificent 7 keep pushing higher, they're going to drag the main indices higher, like the S&P 500 and the NASDAQ. But overall, we just kind of continue to ride this market up and let everything kind of unfold as it wants to here. Last but not least, let's just take a look at this symbol. This is RSP plus IWM plus IWC. So this is equal weighted S&P 500. So getting rid of the large tech heavy weighting. It's the small caps and the micro caps. So this is kind of like to me, I use as the broad market of what's going on. Overall, if we look at the price chart, we've got a nice little pop and flag sideways here to the 5-day moving average. Obviously, we're way off the highs still compared to the S&P 500 and the NASDAQ, which are obviously heavy weighted with the techs. In general, we're still making a series of lower highs, lower lows in the market, but there is more upside potential here. But just notice the long-term moving average here, the 150-day moving average has gone from an upward slope to rolling over. We have a series of lower highs, a series of lower lows, and this still feels kind of like a reaction high, a bear market rally within this market now. Overall, ideally, I'd love to see the equal weighted, breaking out to the upside to be a very strong bullish signal. We still have quite a ways to go from there. It really is just reacting, having a reaction high and moving up into resistance. And again, we just have to let this market mature and figure out what it's going to do. We are riding the markets up with the indice plays. We're long the stock index. We're long some sectors, and we're just going to continue to play this until it eventually gives us an exit signal. And the question is, does this market roll over sooner than later, or does it drag out and continue to push higher and push us deeper into the gains. You can see how these markets, they move from these conditions, these oversold conditions, and just kind of push up and have these pauses and push up, and we have another pause here. So it's going to be interesting to see how this plays out over the next couple sessions. A couple of other sectors actually to quickly look at. XLU, which is the utility space, had a huge rally yesterday, 2%, over 2% to the upside. That can be a little bit of a warning sign that this market might be getting, people are starting to move into some defensive plays. You can see it went into an oversold market condition a couple sessions ago, 2 sessions ago, and then yesterday it opened up and just screamed up to these highs. Another defensive sector is consumer staples, XLP. Obviously, no matter what happens, we're still going to need consumer basic products. And of course, it's kind of had that same thing, a huge pop to safety moving in. Now, overall, it's a pretty ugly chart, but we did see money rotate into these, which is interesting. So maybe it's coming out of gold as a defensive play and saying, hey, let's go into the other 2 defensive stock sectors versus a commodity. Anyways, we'll keep our eyes on how things unfold. We're riding this market and just managing positions. Take care. Bye-bye.